Hi, everyone. Welcome to the Passive Investing Show. I'm your co host, Ashley Wilson, and I'm joined here today with my co host, Jay Scott. We have an incredible show for you today.
Yeah, we have a really good show today. Today we are talking all about crowdfunding. And if you don't know what crowdfunding is, well, you will know by the end of the show. And our guest today is a good friend of mine. His name is Matt Rodak. He is the founder and the CEO of a company called Fund That Flip. Full disclosure, I am actually on the advisory board of Fund That Flip. I've been working with Matt for about 7 or 8 years now. And one of the reasons I got involved with him a long time ago was because I loved his vision for the company that he's built and the asset class that he's been pursuing and the investment opportunities that he's provided to so many investors. And on this show today, he's going to talk all about crowdfunding. He's going to talk about Fund That Flip and how Fund That Flip is serving basically two customers. They're serving those real estate investors who are looking for financing and are looking to borrow money, but he's also going to be talking about how passive investors can get involved and actually be funding those deals for his other customers. So basically how passive investors can provide capital on the platform and generate good returns for that capital that they're providing. Fund That Flip over the last 8 years has made over $2 billion in loans, over 4,600 loans. The company is just performing tremendously, and Matt is a wealth of knowledge when it comes to crowdfunding and how the industry works. So without any further ado, let's welcome Matt Rodak to the show.
Welcome, Matt, to the Passive Investing Show. How are you doing?
I'm great. Thanks so much for having me.
Hey, Matt, we are really excited about having you. So let's just jump in. So you run a company that is focused on crowdfunding. And this is a topic, a term that I think a lot of us have heard over the last couple years. But I assume there are a lot of people in our audience that aren't familiar with crowdfunding, what it is, how it works. Can you kind of give us a general overview of what crowdfunding is and what your company does?
Yeah, sure. So I'll start with our company and then back into the crowdfunding term. And that is a term that was certainly popular back in 2015 and 16, and I think it, to some extent has kind of faded into the background for reasons that I'll talk about. But at our core, we're a real estate investment platform, and we really serve two different types of customers. So one of our main customers are what we call active real estate operators. So these are people that are running real estate businesses like yourselves, right, Jay? You flip houses, you do rentals, you do apartment buildings. And as part of being an operator, you have to have access to capital. Some of that shows up in the form of debt, some of that shows up in the form of equity. But as an active real estate investor, having access to capital is very important for your business. And we're focused on really providing debt, short-term debt, in the single family asset class for active, experienced real estate investors. So if you need a loan on a fix and flip project or a new construction project or even longer term debt for your rental portfolios, we have a business and a team that supports you in getting that debt capital you need to grow your business. The other side of our customer base, if you will, are what we call more passive investors, and I think probably a lot of people that listen to this show would fit into this category. But these are people that have an understanding that investing in alternative asset classes is good for their portfolio and their diversification. They understand that real estate should play some part in that part of that allocation, and they're looking for ways to get access to deal flow. So all of the loans that we originate on that active investor side, we turn around and we make available for investment to this passive group, where you can earn high single digit returns, low double digit returns. It's short duration, it's asset backed, and you can really build your own portfolio, or invest in some things that look more like funds to get the diversification but exposure to this asset class. So that's us in a nutshell. How all this came to be, and I'll give you the short story, is I was an active real estate investor flipping houses and back in 2011, 2012, and couldn't really find a good place to get the capital I needed. You couldn't walk into a bank to get a loan on a fix and flip, and for the most part, you still can't today. Really thought there could be a more institutionalized way to provide capital for people that were trying to grow these businesses, and particularly back in 2011, 2012, that really didn't exist. It was very hard money loans, private money lending. It was very challenging to kind of get the capital to really think about scaling one of these businesses. And I was also doing some personal investing on platforms like Prosper and Lending Club, which were very early in the game around providing access to different non-publicly traded security, if you will, really around consumer lending. So short story is, I was trying to borrow money, couldn't get it, was doing some passive investing in a pretty early entrant around passive alternative investing, and the ideas came together around, man, wouldn't it be great if we could bring this type of thing to this real estate asset class, which I thought could benefit both constituencies. So that's what we did, and some new legislation was passed in right around that same time frame, 2012, 2013, which effectively created a legal framework for companies to go raise capital from people that they didn't know. So one of the reasons that I said that the term crowdfunding has kind of started to fade into the background is what we do is not really novel, right? It's a form of real estate syndication, right? So we're syndicating in our platform, we're syndicating debt, but on other platforms that are out there, it's debt, it's equity, it's a lot of different parts of the capital stack. The only thing that is novel about it is that one, there's new legislation that supports it, and technology has been brought to bear, right? So instead of emails, texts, phone calls, coffee meetings to raise money, we've got technology platforms that allow for that distribution of investment opportunities as well as distribution to a wider network of investors in a legal way, but that also helps bring down costs because of technology and distribution and things like that, which allow some really neat things to happen around like minimum investments, right? So rather than having to have a minimum investment of 50K or 100K or 250K for a syndicator, right? Because that's the least amount you can take to make it worth your while. These technology platforms, ours included, make it so simple that we can have a much lower entry point, which starts at $1,000 on our platform for certain products, which really then helps people get their foot in the door, dip their toe into the water, and start to experiment with this as an interesting new asset class to diversify in their portfolio.
I love that. And so kind of to summarize, basically you have a platform that services two customers. One is the borrowers, the house flippers, the people that are looking to raise capital or bring in capital to execute on their real estate investing. And number two, the folks that are providing the passive funds that really kind of keep that machine going. Now, I know this show is geared towards the passive investing folks, the folks that would be interested in investing on the platform. But that said, as investors, we're always really interested in knowing what we're investing in. So I kind of want to start this discussion or continue this discussion on the other side, the customer, the house flipper. So can you tell us a little bit about what that customer looks like? Where are they located? What level of house are they flipping? How much money are they borrowing? What is their amount of experience? What does a loan look like to them? So what's the LTV of that loan? What's the interest rate of that loan? But basically, whatever we need to know as investors on who's ultimately borrowing that capital.
Yeah, it's a great question, and very important for the passive investor to understand that. So we're primarily focused, like I said before, on the single family asset class, so anything that's a 1 to 4 family. And we're also focused on the segment of the market of what we call experienced and scale up investors. So these are not people that, maybe just got out of a training or watched some TV shows and thought that flipping was an interesting way to kind of, earn some extra money. These are people that have track records, have businesses, have acquisition channels, have, contracting crews, and are really looking for that reliable, cost-effective, transparent capital to grow their business. So we are focused, in some ways it's like small business lending, right? And we just happen to have collateral on the back end. All of the mortgages that we do originate and ultimately make available to our investors are first position mortgages. So, you're in that senior position of the capital stack. And generally speaking, we're doing let's call it 60 to 70% loan to ARV. So our total amount of dollars out the door are going to be, on average, our portfolio is about 65%. So I'll just use that number. 65% of that, the value of that home once it's repaired, with some other things that we're looking at too, particularly around loan to cost. So important for us is that our borrower customers have some skin in the game. So typically we're going to finance 85% of the total cost of the project, meaning that the customer has another, call it 15% of their own capital effectively in a first loss position, but we think that helps us align our incentives. We also have, and this is another benefit for, our passive investors, if you will. We've got a 300-person team, and 120 of them are focused on what I'd call risk. So we've got analysts that are looking at, what is the person paying for the house? Are we buying it right? What's their scope of work? Are they renovating it kind of to market based on, that market and the finishes of the house, et cetera? They're looking at what is that ARV going to be? What do we think it's going to sell for once it's finished? So there's a whole team on the front end, right, making sure that we're structuring the loan to the best that we can to kind of manage risk throughout the project. And then we have a servicing team, right? So after the loan's originated, we've got a servicing team that's looking at things like how are we distributing draws against the work that's been completed to make sure that, again, those loan to value and loan to cost ratios stay in check with what we're trying to accomplish. We have a 14-person legal team, I think, at this point, that's looking at title and contracts and operating agreements. And then we have a whole asset management and workout team. So if things do come off the tracks and need a bit more involvement in terms of finishing the project, selling it as is, working through a foreclosure process, whatever the case may be, to ultimately preserve our investors' capital and get to a speedy liquidity. All of that is resourced, right? So if you're doing that as a private lender on your own with local people that you work with, you've got the benefit of knowing the local market and obviously some relationship and ability to maybe have a hands-on. But we've got a whole team resourced around all of the components of risk, which we think is, by the way, we think is good for our borrowers, right? Because we keep them in check and make sure that we want them to be successful, but also obviously works to make sure that we've got high quality investments, particularly on a risk-adjusted basis for our passive investors.
So that's great. What's the typical time frame of an investment, either from the borrower or the lender side? And do they necessarily match up? Are lenders doing a one-to-one investment? Are they investing in a diversified fund sort of thing? Or are they literally investing in specific assets that they're choosing, and then their investments basically run the course of that investment?
Yeah, so the short answer is they're doing both, or they can do both on our platform. So we have our kind of our bread and butter product, which we call our borrower dependent notes. But that is effectively, you as a passive investor can come onto our website. You can see an entire menu of projects that we financed, and you can click through under those projects and see quite a bit of information about that project. So where's it located? Its address? What did the borrower pay for it? What's their statement of work? What are they going to do with it? A bunch of photos, some narrative around what the strategy is, and borrower credit scores and previous experience. So quite a bit of information about that specific project. And if it's something that fits within the investor's appetite, if you will, with a couple clicks of the button, you can invest as little as $5,000 into that individual project. And the performance of that investment is going to track that specific investment. So if the borrower makes all of their monthly interest payments on time, you're going to get all of your monthly interest payments. If the borrower hits their maturity date right on the nose, that maybe 9 months or 12 months, you're going to get your principal paid back in that 9 or 12 months. And likewise, if the borrower stops making their interest payments, your interest payments are going to stop. If there's any type of challenge or delay in the project, that's going to follow through to that individual investment. So going back to your initial question, our average term on project is around 9 or 10 months. So these are relatively short duration. That's also going to be somewhat a function of the project. So we do a decent amount of new construction. Some new construction projects are faster than fix and flips, right? Because they're a site that's ready to be built. It's shovel ready. The guys we lend money to have almost production builder capabilities where they're in and out of that new build in 60 or 90 days. Whereas maybe we also have larger, 20 townhome development projects that have maybe an 18 or 24 month term, as there's more site development and other things that go into that. So what we try to do from our perspective is match the term of the loan and ultimately the term of the investment to what we think is a reasonable amount of time to complete the project. So some projects are going to be 6-month projects, some projects may be 18 or 24 month projects. And then we also always build in some type of an extension period on those underlying loans, because things happen, right? Permitting delays. Right now, we've got supply chain challenges, and generally speaking, our philosophy on extensions is you've got to be paid current on your interest to get an extension, and your project also has to be on track, right? So you have to have made some progress. There's got to be a good reason for why it's behind for us to think about extending that project. And if there is a good story there and a good reason, obviously probably the best thing to do is extend and give the person additional time. That extension is also not free. So typically there's an additional fee that goes with that, which also gets passed through to investors as compensation for their capital being tied up longer than maybe initially expected. So yeah, we have this build your own portfolio. I personally have over 100 investments on our platform, so I've got probably 60 or 70 different projects that I'm invested in. We also have fund products. So what we heard, really through 2018, 2019 is a lot of our investors were saying, hey, we love what you guys are doing. We love the asset. We love the asset class. We like the yield profile. We like the duration. But I really don't like going in and having to pick 10, 15, 20, 30 investments to get to a $100,000 or $200,000 allocation. What would be great is if I could just give you guys that 100K or 200K, and you could distribute it across a portfolio of basically all of your projects. So we created some products like that there's still debt, but you can write one check and it starts as little as $1,000 in this product. So it's a great entry point for newer investors. But most of the investors that invest in this product are doing slightly larger check sizes. And you're getting that diversification into a lot of different projects that we funded on the platform. The other nice thing about these is the fund product. We call them fund product, but that's probably not a very good name for it. But it's debt, right? So it's debt into an entity that's taking that capital that's raised through that debt and investing in underlying assets. And because it's debt, and because it's not tied to a specific project, it has a very definitive maturity date. So if you invest in a 9-month note into one of these funds, that 9-month comes, you get your money back if you want it, or you can also opt to roll it over. So that was another bit of feedback that we heard from our investors was like the asset class, would like greater diversification, would like a little bit easier, but I also would like more certainty on my liquidity, because when I invest in these individual deals, sometimes I get paid back earlier and I don't want the money back, right? Sometimes the guy finishes it in 6 months and I thought my money was going to be out for 9 months and now I've got to redeploy it. Or I needed that money back at 9 months and this project extended for 3 months, which is okay, but I kind of was hoping to have some of that liquidity back in 9 months. So these fund-like products that we developed solved for a lot of those different things where, particularly if you ladder your investments, which I've got some investments in these fund products as well, you get liquidity every month, right? That you can decide to take off the table and go do other things with, or simply roll over into a new offering that may be available.
So I've heard you mention both residential flips and also new construction. Are the investment types open to, for example, single family rentals or any other asset classes?
Yeah, so as far as the passive investment opportunities, they are all shorter duration, bridge loans, residential transition loans, and the primary reason for that is yield profile, at least historically, right? So these investments are typically high sevens to into the tens occasionally. Before we're filming this on June 22nd, so that for what that's worth. But the interest rate markets went from you could get a 30-year loan in the 5s and 6s, a couple months ago, to that's a little bit different today. But it's also a duration thing. Most investors don't want to buy a 30-year loan, particularly when there's no ability to trade out of that. So we do have a 30-year product that we offer to our borrowers, but we've got more institutional like capital partners that frankly are better takeouts for those.
Switching over to the passive investor side, you've mentioned a few different options in terms of range of duration of their investment. Does the investment return vary based off of the hold period?
Yeah, it can, and particularly for our we call them series notes, which is the fund-like product. There's typically a correlation to duration in rate, so you're going to get a slightly higher rate, longer duration, slightly lower rate for shorter duration. For the individual projects, I would say the duration has less of a correlation to rate because there's other factors there around borrower experience, loan to value ratio, market that the project happens to be in. So, we have an internal scoring mechanism that ultimately helps us, price the loans. And generally speaking, that pricing is going to flow through to our passive investor base based on a number of different criteria that we're looking at to ultimately price for the risk.
You mentioned that the minimum loan amount or investment amount is about $1,000. Do lenders or investors on the platform, do they need to be accredited? If so, is it self-accreditation, or do they have to go through a formal accreditation process? What does that look like?
Yeah, so this goes back to kind of the legislation that was passed in 2012, 2013 around, it's called Reg D, right, that makes all of this available. We're using a specific part of the regulation called Reg D 506C. So the 506C piece is what allows us to do what's called general solicitation, which means we can have a website, we can do Google AdWords, we can talk about the fact that we're raising capital on a podcast, right, to people that we largely don't know. What the SEC has said is if you're going to use this exemption, the 506C, and generally solicit, you can only take dollars in from accredited investors, and you also have to go through the extra step of verifying that they are in fact accredited. So the short answer to your question is accredited only, and there is a verification process. We do leverage a third party to help us with that, which is all technology enabled, and most people can do it in 5 or 10 minutes. We also have a form that if you work with a CPA or an attorney or something like that is privy to your financials that can simply sign off on it and send it back for our file. So it's a relatively painless process, but it is something that's required for us to maintain that general solicitation exemption.
So you mentioned you've been doing this Fund That Flip's been around for many years now. So I presume that you have a good amount of data on the performance of your loans. And so can you give us some idea of, and I don't know how much specifics you can go into, but how many loans have you done over the years, and what's your default rate, and what is the performance of those loans? What can I or somebody else that might want to invest on the platform, what can they expect in terms of risk and return?
Yeah, so we've done, I think last I looked, we've done about 4,600 loans. We're approaching 2 billion in total origination volume. The way to think about default, and I'll share some statistics, and for what it's worth, we post all of our performance of our portfolio onto our blog on a monthly basis. So we're very big into being transparent with how our book is performing. The way I like to talk to passive investors about this from a risk perspective is, there's more of a liquidity risk than there is a loss of principal risk, and the loss of principal risk is not zero, right? And we have had some loss of principal in some of our loans, but because these are first position mortgages, because these are structured such the way that they are with the LTVs and the LTCs that have some equity in front of them, there's a pretty high probability that we're going to be able to get all or most of your money back. But you may end up being in that investment for longer than you intended, right? So if it's the worst possible case scenario in a judicial foreclosure state where we have to actually run the project through the foreclosure process, that can be a 2 or 3 year process where your investment is tied up and not earning any income, which obviously has a cost to it. But when we get through that process, there's a pretty high probability that we're going to get all or most of your money back, right? So I like to talk about this of if you're going to invest in this asset class and you for sure need the money back in a certain window of time, and it's another benefit of the platform is diversify, right? So if you've got $100,000 to allocate to the strategy, don't put $100,000 into one loan, put $5K into 20 loans, or $10K into 10 loans. But I think that's one of the ways to think of this is it's like a lot of alternative asset classes. One of the downsides to them is there isn't a secondary market. There's not a lot of liquidity for these things, and this is certainly true for our stuff. To more directly answer your question around performance, we've returned, I think, 99.5% of principal across everything that's repaid. So again, it speaks to that fact that there's a high recovery rate on any loan that does potentially go bad. We're typically, we kind of track defaults in really 4 different buckets. So what are the loans that are 30 days late? What are the loans that are 60 days late, meaning they missed 2 payments? What are the loans that are 90 days late? means they missed 3 payments. And then what's the fourth bucket, which is like squarely in our asset management and being worked out and probably has a longer horizon. Across all of those 4 buckets, we're typically 6 to 8% of our overall portfolio. So if you invested in every loan, right, that was available to you, you're going to have, let's just call it a little under 10% of your portfolio that's maybe not paying current, right? Some of those are going to get caught up quickly, right, in like 30 days, and now you're back to current. Some of those may take a little bit longer, but in the bottom buckets, which we care most about, that 60 and 90 days, because that's like we've missed more than one payment, we're worried. We're typically like 3 or 4% of the overall portfolio, so a pretty small percentage. And I think we've only foreclosed on like 25 properties, 30 properties, something like that. So there's usually a better path forward than foreclosure, which is get a deed in lieu, right, from the borrower, do some horse trading with a personal guarantee to do that and save time and money. We've got relationships with a lot of people that like to buy these loans, right? So just sell the loan kind of to a non-performing loan buyer. Maybe keep the borrower involved and like help them get the project finished with our own crews and people that we know in market. So we take a pretty active approach and creative approach to ultimately, again, our goal is preserve principal, get liquidity as quickly as we can. And there's not a one size fits all for that. It's really dependent on the project and ultimately the sponsor.
I think the thing to really stress, though, is that you're taking a lot of the headaches out of the hands of the investor. So if the investor is concerned about the default and having to foreclose, and maybe they're already private lending today, this is a great alternative where your company takes on the responsibility of actually going through that foreclosure or getting the note reperforming with the active investor. So with respect to some return expectations for the passive investor side of things, how frequent do you pay out distributions? Is it on a quarterly, monthly, annual basis, or is it just, once the project goes full cycle? What does that look like? What are the expectations that they could have?
Yeah, so distributions are made monthly across all of our products. We typically push those out on the 15th of the month or around the 15th of the month for the previous month's accrual period. So let's say you make an investment on June 22nd, which is today, your investment will start accruing and you'll get 8 days of interest in June. So in July 15th, you'll get an interest payment for those 8 days in June. And then when you get into August 15th, now your investment will have an accrual period of that entire month of July. So as long as that underlying loan made its interest payments, you'll get your interest payment for the month of July on or around the 15th of August. All deposited directly either into your bank account, or we also have kind of a FTF wallet, if you will. So if you like to keep kind of the proceeds of your investments on platform so they can be reinvested, that's an option as well. But yeah, all monthly pay, and then obviously principal gets returned at the end of the project or maturity date, depending on the product that you're invested in.
And if an investor wants to invest with their self-directed IRA, do you accept those investments as well?
We do. It's one of the ways I invest on our platform. So we work with a number of different self-directed IRA platforms. I've set mine up as a checkbook control IRA, which makes it a little bit easier for these types of particularly if you're going to do smaller $5,000, $10,000 investments, because the IRA custodian's fees can add up depending on what you're doing. So I've set up a checkbook self-directed IRA, which is a little bit more expensive up front, but saves a lot of time and convenience, particularly if you're going to commit to this type of asset class.
And probably safe to say, but I'll let you say it anyway, because our listeners are always asking. I assume no tax benefits associated with these particular investments, specifically because they're flips and short term, and they're loans.
Yeah, so these are all, for the most part, ordinary income. So you're going to get a 1099 INT from us at the end of the year. One of the nice things about these is because it's the way that this is set up, you're going to get no more than 3 1099 from us. So if you're invested in the individual, one-off projects, all of those kind of are under one entity. And then each fund, we've got 2 different funds as its own entity. So, if you're doing kind of more of like equity investing, you may have I've got some of this, 15, K1s at the end of the year. If you are making 20 or 30 or 100 investments, for the most part, the reporting stuff is pretty easy from a 1099 perspective.
Yeah, and it is nice to be able to get 1099s instead of K1s, because if you're doing your own taxes, it's going to be a lot easier. Even if
Yep.
you're not doing your own taxes, it's probably going to be a lot cheaper to hand your accountant some 1099s as opposed to K1s.
Yep.
If someone was interested in investing with you today, is it as simple as just going to your website and registering and being able to invest right away, or is there an interview process? What are the next steps that our listeners could take if they're interested in investing with you?
Yeah, so it's pretty simple. You can just go over to fundthatflip.com, create an account, which is pretty basic: name, email address, things like that. The next step to actually then be able to invest is to set up an entity. So who's going to be the investor? We've got capabilities to set yourself up as an individual. We hit on the self-directed IRAs. We also have a decent amount of people that invest out of trusts, LLCs, right? So you can set up a different type of entity. Once that entity's set up, then the next step is connect a bank account, right? So we can pull money from and send money to. That usually takes a couple of days to confirm through a traditional micro deposit kind of setup. But you can actually start making investments before that's complete. So once your entity's set up, and we've got your tax IDs and addresses and everything we need to do from a know your customer and anti-money laundering perspective, which typically is pretty instantaneous. Your account set up, you can start making investments, and then the investment won't become complete until the money obviously can clear, which needs to kind of go through. You need to go through that bank account setup, but most people can do it inside of 5 or 10 minutes in terms of actually setting the account up. And then after you make your first investment, we'll work with you on the accreditation process, which again is pretty straightforward, of either getting an accountant or an attorney to fill out the form, or going through our online partner that again upload some bank statements or tax statements, and that's usually done pretty quickly as well. We also have something I encourage everyone to check out. We have a 12-step guide on how to get started with investing. So in addition to obviously account setup and all that stuff, how to think about building a portfolio, diversification, what criteria are important to look at from an LTV, LTC. So we've got kind of some things just to help people kind of climb that learning curve and get comfortable with the asset class, and ultimately how to be thinking about constructing a portfolio that's right for your individual needs.
Perfect. Well, we're now at the point of the show where we're going to transition to our 3 questions we ask every single guest. So we are going to start with our first question, which is, what new thing have you recently invested in personally or are researching?
Yeah, so I think one of the things that's been super interesting to me is I also like angel investing. So I do a lot of real estate investing because it's something that I'm close to. But I've got involved with an angel list syndicate that's focused on prop tech companies. So I think we've got I don't know, 70 or 80 prop tech companies in this angel list syndicate that I've been doing for a little over a year now. So that's been super interesting just to see the different types of companies that are getting started around the space that I operate in, and occasionally get an opportunity to meet some of the founders and try to be helpful. So it's been a lot of fun.
Yeah, and I know, Matt, you and I are actually in the same prop tech fund, and hopefully we're going to have that fund manager here as a guest on one of our upcoming shows as well.
Yeah.
Yeah.
I wasn't sure if you wanted me to out you on that, but yeah, Jay and I are in that one together.
Yes, we are. We are. Okay, question number 2. What current legislation or economic situation do you think poses the greatest threat to either your business or the crowdfunding industry in general?
Yeah, so I think as far as like legislation around the crowdfunding space, I'm less concerned about. I mean, I think it's pretty well baked in. I think there's a track record. I think there's a pretty good framework there that everyone's comfortable with. I think the industry's also been very responsible in kind of self-regulating and making sure that we're doing things the right way. I think the thing that's top of mind for me now is just inflation, right? And what that's going to do in terms of the strength of the consumer and strength of businesses, and ultimately how the Fed responds to that, which is already starting to have an effect on cost of capital, which will have a lot of implications in terms of how much house can people afford, what are cap rates for commercial properties, and other things like that. So we're in a period of a transition, I think, from a free money environment to money actually costing something again, and that's going to change, I think, a lot of dynamics across a lot of different asset classes, and I don't think anybody really knows what that means yet. So something we're going to have to keep a close eye on, I think.
Excellent points. Our third question is, what is the best piece of advice you have ever received or are willing to share with our listeners?
Yeah, I mean, I think the one that immediately popped to mind is try to never be the smartest guy or gal in the room. So I think as our company has evolved, and I was fortunate enough to get to know Jay early on, and that helped make sure that remained true early on, that I wasn't the smartest guy in the room. But as things continue to grow, I think it's important to surround yourself with people that have different perspectives and experiences and knowledge that you can learn from. And it's one of the reasons I think that we've had the success that we've had is, a continual pursuit of trying to learn something new every day, and not getting too comfortable with, what you think you know.
Awesome. Matt, absolutely love this. Okay, before we go, for any of our listeners that want to find out more about Fund That Flip, they want to find out more about you, they want to find out more about investing, where can they reach out to you or learn more about you and the company?
Yes, I think probably the best place is fundthatflip.com. Our content team does I think a pretty good job of putting stuff out on, the markets and how to think about investing, and, our latest kind of take on, what's going on. For better or worse, I'm not one of those super active social media guys, so email for me is probably still the best, and I'm reachable at matt@fundthatflip.com. So happy to answer any questions that I can about investing on the platform, or if nothing else, get you pointed towards the team that can help you. But yeah, pretty available via email.
Excellent. Well, thank you so much, Matt, for joining us today. For all of you listeners, you can listen, obviously, on your favorite podcast platform to all of our previous episodes, and then obviously this episode if you're catching us there, and also on YouTube. So make sure that you like, subscribe, and review on those two platforms so we keep providing this great content for you. At the end of the day, we hope this episode helped continue your journey of having your money work hard for you. Thank you again, Matt, and thank you, Jay.
Thanks, Matt.
Thanks for having me.